Welcome back to the Anomaly Angle, and today we're going to focus on those that have a single income household with different fact patterns. Because the fact is, if you're a single income household, one spouse working, one spouse not working, there may be a great tax strategy you can take advantage of that could save you thousands or even tens of thousands of dollars year after year if you're willing to put in some effort and work. And it's an exciting tax strategy we've implemented so many times. We're excited to explain it today and go through an actual case study. But before we get there, John, welcome back. How was your week?
Week was good. I don't know when this will exactly air, but we're kind of in the midst of tax season, so it's a little hectic. But teams move and work, and we're getting things done, so it can be a rewarding part of the year too.
Absolutely. Tax season's always it's a lot of work. What ends up happening is you're compressing really 12 months of work into a few months, looking at last year's results for clients. But it's a rewarding part for us as well because we can see a lot of the tax strategies we put into place and how much they've saved and hopefully deliver these really great results for clients. And today we'll even talk about great results you've delivered in the past. So we'll get to it here, John.
Yeah, so I mean, this fact pattern, I think, in my opinion, has been one of the most, I would say, like the greatest return on your time and investment that I can say that we've done repeatedly.
Sure.
And it doesn't fit into everyone's situation, but when a fact pattern comes to us that is like this, for us, like our eyes light up. Like we can do huge things, family.
Absolutely. And for those that have watched other episodes, you'll know that our process at the beginning, right? When we have a new prospect contact us, right? We have a filtering system. They come in. If they're a good fit, we sign them on. And we do what's called a tax plan, or we call it an assessment and advisory at the beginning. And during that process, right, our team really spends several hours reviewing multiple years of tax returns, a deep dive discovery question into everything on their financial lives. So think about their investments, their holdings, to really say, hey, what's the puzzle here and how can we solve it? Now, in this case, the family came in. We had a business owner that came in making good money. I'd probably, if I recall, $600,000-$700,000 per year, and married family, right? So we're looking at the fact pattern in right away, right? Something jumped out to us that we don't often see, but we see once in a while. And what was that, John?
It was real estate. So they had a huge real estate portfolio that they had accumulated over time. And I mean, I shouldn't say huge, but just something that they were like buying one property a year, over the course.
Wouldn't call them like real estate investors per se. Really a business owner
No.
that just had extra cash, and over time he just started picking off properties, mainly locally. He was here in Massachusetts, but properties here and some in other states, I believe, as well.
Yeah, and a family that has had made money over time and just wanted to invest in real estate, and they'd done it, diligently and had accumulated a huge portfolio. So we see that, and that's one of those things that kind of like a bell rings in our head. And then the other component of it is, okay, this is somebody that's comes in, they're getting crushed by taxes year in and year out. They're high income, and there's really been nothing done to mitigate it. And then we realized that his wife, was not working, but was someone that was kind of active in their investment life.
Yeah, so that was a kind of a key tipping off point for us. We looked, and they'd just been reporting these several rental properties, right? Schedule E, which is normal, and they were reporting them as passive, which is fine at the time. But they clearly came to us for a reason, right? Business owner doing well. He was paying relatively high taxes. You're making, $600,000 to $800,000 on an annual basis. Your tax liability is going to be high. So we looked at this and we said, okay, like what's your thoughts on real estate? No, we like it. We're not super acquisition mode, but we buy them when we see good opportunities, right? We think it's a good inflation protection return, which we agree with. So we got into it, and then we said, okay, well, we have a clear case here where we might be able to use the laws to our advantage here by qualifying the business owner's spouse who stayed at home with the kids, and some kids are older now, I believe, but had not been working full time or not working at all, qualify her as a real estate professional. So that was the first thing we thought of when we saw this fact pattern. Now, we start to do this, right? You can't just say, oh, great, check a box, move on. You really have to understand the lifestyle and how this works. So we approached them during our tax planning. We said, right now, because we want the facts to dictate what we do, how are you kind of managing these properties? Again, like I said, most of them are local. And they said, we do it. We do all the management. We deal with everything. I think they're as a family, they kind of dealt with it, and they helped out. And they said that, when issues happen, which weren't all the time, most of them are long-term rentals, they dealt with it. But as far as like the back office type of stuff, the leasing, the management, the physical maintenance, they coordinated, did all of that themselves. themselves. They said, okay, that's great. So that kind of was a big hurdle in our mind before we even explained the tax strategy to them. We wanted to understand what they were doing.
Because a lot of times there's the flip side, right? Where there's a spouse that is maybe not working, but maybe they just have nothing to do with the portfolio. Maybe they're taking care of the kids. Maybe they're doing something else on the side. And you can't, like Greg said, we're not just checking a box here. There is a lot of rules that we'll get into that you have to pass muster, and part of that is a devotion of time. But we can't square peg round hole this type of thing.
So as we started explaining to them, they were obviously interested, and we said there could be big tax savings. And the first question we had to ask is to the family, and particularly the spouse, was, are you willing to be kind of more full-time in real estate and take the reins, right? Because it seemed like everyone was doing a little bit, like the family, kids, the husband was doing a decent amount. We said, are you willing to put in the effort to do this? And the answer was clearly yes when they saw the result. So we had to kind of coach them through this, and that will bring us to the rules, right? So we'll talk about the rules here. We'd explain to them. And test number one for the real estate professional is, number one, you have to be in a real property trader business. So there's a bad misnomer out there. We see it on social media all the time from influencers that don't really work in this industry. They'll say, yeah, have your spouse get their real estate license. Their real estate license has absolutely nothing to do with this, right? So nothing to do with the real estate license. It is a real property trader business, which is about 10 of them. And if you're in that, right? So one of them is renting or leasing or acquisition or disposition or construction, reconstruction, the list goes on, which they're obviously doing. So we have the box checked, right? They're in a real property trader business. Number two, are they willing to spend 750 hours in that real property trader business? And then number three, 51%, right? Or greater than 50% of all personal service hours that they say are in real estate. Now, test two is real easy here because the wife, in this case, or the spouse, they did not have another profession, right? So there's no other personal service hours. Like family time is not personal service hours, it's working hours. So there was no question we were going to check the 51% box. The 750 is where we really had to say, okay, do you guys have an understanding how much time you spend across these, I think, 5 to 7 properties? And I think they had a decent idea, but not a great idea, right? So that we said to them, okay, well, 750 is what we're gonna have to get to. And then the last test we had to explain to them, which a lot of people get confused, is what's called material participation, which means that, hey, to keep it simple, the activity that you're pouring in here to the real estate, it has to be material to the profit endeavor that you're seeking, right? So sitting at home, listening to a Bigger Pockets podcast, we love Bigger Pockets, by the way, but listening to a Bigger Pockets podcast or scrolling Zillow, that is not gonna be a material participation hour. And trust us, people try this stuff, it goes to tax court, they lose, so don't do it. So we explained all these rules to them, and they said, we think we're around that. We don't really know. So when we hear that, John, where do we go next?
So I mean, where do we go next from the standpoint of if we don't know if we're going to be hitting the material
exactly the 750?
Yeah. So I mean, the big thing is we need to make sure that we're tracking. So we put together trackers, right, that we have, and again, we're not reinventing the wheel here. We want to make sure that we're tracking the hours for those specific activities, and we just have contemporaneous log, because the worst thing that could happen is you get audited 3 years down the road. We're going back 3 years and we're trying to completely reinvent our time and figure out, go back to calendars, and it's a complete disaster doing it that way. So if we have ironclad contemporaneous records, it's easier to defend an audit, and from an auditor's perspective, it's okay, these people are buttoned up, they have their time, this is a good thing. So we put that together for our clients. There's other applications that you could use, mobile applications and things of that nature that might make it a little bit more efficient for you. But once we have an understanding of what that time is, then we can feel better about moving forward.
Yeah. So the big thing we do with our trackers is make sure we talked again about those categories that count and don't count, right? So we use the IRS audit technique guide, which is public information, right? If you want to go to the depths of the IRS website, you can find their training materials. It's all public. So we use that to make sure that the categories that our clients are tracking line up with what's allowed. So we literally red flag on these trackers, things like travel and education, because education's iffy, travel is 50-50, right? Depends on what you're doing. In this case, I mentioned, the properties are mainly local, so local travel is fine. What's not gonna work is if, say, you live in Boston and your property's in Fort Lauderdale and you decide to fly down there, they're not gonna necessarily count that time, right? They're gonna say it's unreasonable. So long story short, we get the trackers together. And what the big thing for us is, guys, we want to do this strategy with you and you're willing to put in the effort to do it, but we gotta let the facts dictate what happens. In other words, this is not a retroactive thing. We can't say, oh, great, we did this last year before you met us. No, it's a proactive thing. So we said, okay, great. Now we're headed, I think this is 2025. So we said, headed into this year, let's now make sure we track this and let's check in every quarter, every couple months to make sure we're on track. Because if you're in July and you're at 100 hours, right, we're not going to be looking good. So we had them do that and say, look, at the end of the day, if you don't get there, it's not the end of the world. It'll just be same as usual. But if you do get there, that kind of unleashes part two. So part two is you get the real estate professional box checked. Some people are like, oh, great, I'm a real estate professional. They start posting on social media. That doesn't do anything, right? A real estate professional in its own, all it does is make the trade or business non-passive versus passive, right? So real estate is passive by statute, section 469. By converting to a real estate professional, you're gonna have a little tiny box at the bottom of Schedule E2. It's really underwhelming, right, for all the work that goes into it. And you're gonna reconcile I'm a real estate professional.
Which is ironic because we
Right.
said we're not checking a box, but we are checking.
Correct.
We are checking a box.
We're checking a box, right? Like some of these things in the tax world, the amount of work that goes behind it for an underwhelming field on a tax return is funny. But then that's also why this gets audited all the time, because you have these DIY people or even people like go into ChatGPT saying, I have a real estate license. It's like, great, you're a real estate professional. It's not how it works. So we qualify them there. We do all the work to do that. Then part two is now you're non-passive, right? That's great, but like on its own, it's not gonna do a whole lot. So this is what happens next. We looked at their whole portfolio and this is where it gets tricky. They had bought these over several different years. So we had explained to them, hey, there's something called a cost segregation study we can do next. And what that's gonna do is really break down the component parts of your properties into buckets, right? You're gonna have land, which you never depreciate, and then you're gonna have the building itself, right? So the physical infrastructure of the building or the house, I should say. That is all gonna be, the land's one bucket, non-depreciable, the building's another bucket, that's gonna be 27 and a half years of depreciation, right? So over 27 and a half years, you're gonna write that part of the building off. That is the default, right? So if you just buy a property and you get your settlement statement, your accountant's gonna put on your tax return approximately 15 to 30% of that's going to go to land value. The rest is going to go to building. You're going to write that off over 27 and a half years. Great. Cost segregation study takes that 27.5 portion and breaks into smaller components, because I look around, right? We have a carpet down here. We have a wall that's actually temporary. We have signage. We have light. We have all this different stuff, right? They all have different lives in the tax code. But when you buy a property, it doesn't tell you that, right? It doesn't say, hey, the house that John bought has PVC tile or it has this fixtures, right? It doesn't tell you that. So a cost segregation study, an engineering-based study, is going to tell you that information. So we go through that process with them to do that cost segregation study. That's going to give us the buckets, right? The 3-year bucket, the 5-year bucket, the 7-year bucket, the 15-year land improvement bucket, and the remainder goes to the 27.5-year bucket. Now, John, why do we care about the 3, 5, 7, 15-year buckets?
It's very clear, so we can accelerate that depreciation, right? So that all, depending on the year it's put in service, and we can get into those rules, but we can accelerate what's in that 3, 5, 7-year bucket immediately in that year. So that can create like a big non-passive loss against, you know, someone that has a lot of non-passive income like this client.
So key point there, right? This is something that even some accountants can mess up sometimes, and because it's confusing. You work on the rules in the year in which the property originally went into service. So in this case, I mentioned that we did this in 2025, right? 2025 is a tricky year with depreciation because of OBBB, which started on 1/19/25. But ignore that for a second. We don't just blanket follow 2025 tax law. You go back and look at the year in which they placed this in service. Fortunately for them, these are mostly COVID properties, right? So 2020, 2021, maybe some in 2022. So we look at the year in which the property was physically placed into service, and we look at the IRC 168K law of that year, because it's a sliding schedule, right? It moves around all the time depending who's in power. That time, it was 100% bonus depreciation. So the next question we get oftentimes is, well, that's a huge pain. Now you got to go back and amend 21, 22, 23. No, you do what's called a change in accounting method. So again, in accountant speak, what we're doing is filing a form 3115. But in reality, what we're doing is we're saying, hey, IRS, just letting you know, we went through this process. Technically speaking, the client actually made a mistake because they had a table that they depreciated over 27 and a half years. But according to law, That's written off over 3 years. And according to law, you can accelerate that in 1 year. But they did it wrong, right? Because they didn't break it out. So you're doing what's called a change in accounting method from an impermissible method, right? It's not permissible to depreciate this table over 27 years to a permissible method, which is the short-term life. So again, that's all nuance, but that's kind of what's happening behind the scenes there. And what we do is we wash that big loss that John mentioned, right? So the 3, 5, 7, and 15-year land improvements all get bucketed up. We add all that up, and we are literally taking that large expense and washing it through the 2025 tax return. I say wash as a funky word, but we're running it through that tax return, and you list it on your Schedule E. It's called a Section 481A adjustment, and you create a big loss, right? So in this case, let's say they had $50,000 of rental income, but we had $100,000 of loss. I'm making these numbers up. We have a $50,000 non-passive, or another term for that is active loss. That active loss now goes and offsets the business owner's taxes. But in this case, way bigger, right? I think it was probably 350 or 400,000 of accelerated depreciation we're able to get there. So that 350 or 400,000 of accelerated depreciation from prior years that we're putting on 2025 directly goes and offsets the business owner's income, right? So the 6 to 800K I mentioned, that's directly offsetting that, right? Because spouse is now a real estate professional. It's a joint status. We did all the process to get the cost segs done. We accelerated 481A, 30115s, voila. All of a sudden, they're in a great situation because although they made about 6 to 700K here, they're only paying tax on about 400K, right? So what a win that is.
Yeah, huge win. And just to illustrate why real estate professional matters in this instance, if we did this whole cost segregation study on someone's portfolio and that status was not elected or we didn't qualify for that status, you would still get those losses, but those losses would be passive. So it would offset passive income in your life. But like in our instance, the husband, the high earning spouse was making, like Greg said, between $600,000, $800,000 a year. That's non-passive. That's that active income. So that the passive losses and that active income, they wouldn't net. So you would generate these passive losses, but they would just get stuck on your tax return unless you had a ton of passive income.
Key point there. Oftentimes we see, like, we love our cost segregation friends, but sometimes these companies will send unsolicited emails to people. You can find out who owns properties, right? It's not that hard. They'll send unsolicited emails to them saying, hey, you should be doing a cost segregation study, without knowing, like, anyone that tells you to do a cost segregation study that's not seen your personal tax return should not be telling you to do a cost segregation study because they don't know your character, right? Are you an active or passive investor? The chances are you're the default. Default is passive. You could have a married couple that both work W-2 jobs or both own businesses that have 40 rental properties, and you're going to be passive by default. You're not going to overcome the 51% test. So be careful if someone just tells you to do a cost seg study.
No doubt.
You really need to understand these rules and listen to your accountant, right? Don't listen to the salesperson. Listen to your accountant. They're going to protect you here. Now, you may need to educate them on some of these nuances if they don't know it, or tell them to look into this. But be careful if you're getting sold a cost seg and you don't need it, because what John mentioned there is if you're going to be quite disappointed if you pay for a cost seg, get that $400,000 loss, and your accountant says you owe the same money as last year because it's a passive loss.
It just carries forward.
Carries forward. Now, there's many strategies we have. We'll do another episode on that. How do we use passive losses? We find what we call pigs. That's a whole nother story. So to wrap this kind of up, right? Like in this case, I think with the magic that happened here for these people, number one, we let the facts dictate the pattern, right? The spouse tracked her time throughout the year. We were able to get comfortable. I think by the third or fourth quarter, we knew it was going to work. So the other thing here is, like, a cost seg study is not that time sensitive. You don't have to do it before 12/31. So we were able to do this into January of 26. But we felt confident there, right? We had good records. We had the time logs done, 51% automatic check for us, 750 hours done, quantify the cost segs, run them. But here's the trick. We mentioned, like, they'd already paid in their estimated taxes, right? So they had a big refund coming back to them. I think the worst thing you can do here is take that refund and just put it in your checking account, right? This is how a snowball strategy starts. So if they're saving substantial money in taxes, either through not paying the tax or getting a refund, depends on what they paid in. The idea here is to take that and then reinvest it as a down payment onto a new property and keep the snowball running, because the music's gonna stop eventually, right? And you wanna have a seat. If you don't have a seat, you're gonna have to start paying tax because you're using a lot of your depreciation. So the most influential and the successful real estate investors, they're doing this. They're saving the tax and then they're reinvesting those proceeds as down payments to new properties, running the cost seg playbook again, getting the refund or not paying the tax, reinvesting in new properties, and they wake up one day and they have 40 properties, right? Pretty cool. So like, that's a key for us, is not that we're telling them they have to do that. It's just really understanding hey, if you want to make this a perpetual strategy, you got to keep buying.
Yeah, totally. So before we wrap up, I just want to go back to the rules, throw a couple rapid fire FAQs that we get
All right.
a lot. So I'll throw these at you. So on the real estate, the first prong, it needs to be a real estate trader business.
Correct.
One question we get
Yep.
is,
sorry.
Do I need an LLC?
You do not need an LLC, right? You do not need an LLC to do this. And because you have an LLC doesn't mean you're a real estate professional. Again, so like if you work for Caldwell Banker as a W-2 employee, you are not in the real property trading business because there's a lot of subsets to these rules. You must own 5% or more of the venture, right? So if you just work as a W-2 for a real estate company, you're not like automatically in a real property trading business because you're an employee. You have to have a skin in the game as an owner.
Right. Okay. So 750-hour rule question: can me and my husband both accumulate aggregate amount of 750 hours?
Yes, you can. So you got to be careful of the nuances here because it's a little bit different between material participation and real estate professional hours. They're related, but not the same. But remember, all of these hours too have to be, all of your tested hours have to be material participation. So like I always harp, do not rely on travel, do not rely on education. Can you use a little bit of education, a little bit of travel? Yes. I would be very skeptical as an accountant or as someone signing off on this if they had 760 total hours and like 20 of them were for travel, because if you run into an unfriendly auditor and then they mark those as non hours, they're going to say it's not active. You're now facing going to tax court, which is an expensive endeavor. Don't leave it to chance.
Yeah, right. Okay. So on the more than 50% of your time, okay, I'm the spouse that's going to qualify as a real estate professional. I have this small W-2. Can I still qualify?
Possibly. Right now, this is where like practicality versus reality comes into place. Now, if like the IRS, let's keep it simple here, right? The IRS uses algorithms. The IRS has AI. They have computers, and they're not as bad as you think they are with this stuff, right? So very simply, I think a lot of time when people get audited for this is you report W-2s on a tax return and you check a box or a field for real estate professional. They are aware if there's a T and an S W-2, right? Taxpayer and a spouse W-2, and the third thing is a real estate professional. I'm telling you, you're getting put into some bucket on the right. Doesn't mean you're going to get audited, but now you're in the naughty list, right? They're going to look into that. Now you might get inquired of. If you get inquired of, then the burden of proof is on you, not the accountant, not the IRS. The burden of proof is on you to show that that W-2 that you as the spouse or you earned in this case is less than 50% of your time. How do you do that? You better have good records, right? Remember this one thing, if you remember anything from this video, in the world of tax, it's the opposite of the criminal world. The burden of proof is on you. You are guilty until proven innocent, to keep it simple. So the IRS is going to come in and say, John, tell me why you and Kelly are claiming this status. Show to me why someone's a real estate professional. And if you can't do that, you're done. Is there a law that says you must have a paper time log and an Excel sheet? No. But there's a believability factor here, right? If they come in and you don't have these things in the order, they're going to laugh at you, right? There's all sorts of funny cases out there and they're going to say, okay, yeah, you didn't do this. The best defense is a good offense.
Yeah. All right. So W-2s, you gotta dig into it a little bit more, and it might not be worth your time, right? If you can have these like huge losses. All right. Last one is, so bought my property, doing a lot of renovation on it, and just trying to determine the in-service date. Like, what does that mean?
So in-service date, right? The rule is available and listed for rent. It doesn't necessarily mean that it was rented. It's in-service, meaning it's up and ready, right? So if you bought a property, you have to do like renovations and I don't know, different stuff on closing, and it's not open, right? You're doing renovations. That's not ready. That's not rent ready. Once you hang that shingle, sign's ready, that's your in-service date, right? It's available for rent. When we're talking about long-term rentals here, I'm not going to get into short-term rentals today, but long-term rentals, that's when it'll be available. We've actually dealt with an audit before here where we had to go through that because it was a property that was held for rent, just didn't really rent, right? So there was no rental income on the top line and there was expenses. We just had to kind of prove to the IRS, hey, this was ready and available for rent. It just didn't rent that year. So the rule is available and ready to rent.
Yeah. All right. You passed.
All right. Well, John, we'll see you next week. Good week.
Awesome.
On to the next.